Hello, I'm Maria. Every major project, whether it is a construction, development, a new plant, or real estate investment, starts with one key decision. Is this investment worth it? So, the techniques are being taught now, the capital budgeting techniques. Is this investment worth it? In this session, we will break down three core capital budgeting techniques: payback, discounted play, discounted payback, and net present value. I will explain them in simple practical way and show you how they are actually used in real world project decision. So the key question is the investment worth it? When will we recover cash? Does it create value? So, starting with a payback period, when you invest, then after some times you start getting the rewards, you start getting the money from the investment, and the time period in which your investment is recovered is the payback period. So, simply speaking, payback period is the time to recover the investment. It focuses on liquidity and it's a simple decision tool. So, if you go for the payback timeline, then you invest in the year zero. It's mean uh, presently you invest some money. After 1 year, you will get something back. After second year, you will again something get something back, and each year you are getting some money back. It may be any project in which you have invested recently or in the present year, that's the year zero. So, coming to the payback timeline, actually, what happens here that when you invest some amount, suppose you are going to invest minus 100K, 100,000. On the first year, you get back 40,000, second year again 35,000, third year again 30,000, and it may be fourth year, fifth year, sixth year, seventh year. So payback timeline or payback period is actually the period when you will recover all of the money you have invested now. If you have invested 100,000 now, then the time period or the years in which you will recover back the whole amount of money is your payback time period. So, starting from the year one, 40,000, year two, 35,000, 40 plus 35, it's mean in year two, you are getting 75,000 back. And year three, you are getting a total 105,000. So it's mean that you have recovered your whole money during the year two to year three. So it depends at what time you have recovered it. So it is if you are working on a project and you are getting some money back, then you think that your investment has been recovered in 2 years and some more time, but before year three. So it is a very simple method which is understandable to everyone. So you can find it out that remaining after year two is in year one you recovered 40,000, in year two 35,000. So in year two you have already collected 75,000, and now in year for the year three you need 25,000. But you understand it is 30,000. So in how much part of the year two after year two you have recovered the 25,000? You can find it from here. The remaining after year two is 25,000, and the total in the year three was 30. So 25 over 30, it is equal to 0.83. So it means 2 years plus 0.83 years. So your payback period will be 2.83 years. So this is very simple method. It has some pros and cons. It is easily understandable, but it doesn't count the present value of money. So, though it is easy to compute, but it doesn't give the actual picture because it doesn't tell anything about the interest rate, inflations, or what, or if you simply understand that what will be the, you didn't consider the present value of money here. So to go to avoid this discrepancy, we can go to the discounted payback period. Discounted payback mean that you want to consider the present value of money so that you consider time value of money, then you use discount rate. Discount rate covers many things like interest rates, or you can say the opportunity cost. If you invest the same thing in any other project, how much you can get if you invest the same money in some bank or in some other project. So, what can you get from there is your that is to consider that rate. We consider we use the discount rate, or it is just like interest rate or rate of return, and it is very realistic because it considers the present value of money, and you can say that inflation is also covered a little bit in this method. So discounted method, considering your interest rate as 10% or rate of return, sorry, you should say it rate of return as 10%, that if you work on any other project you will get 10% back from that. Then reconsidering the whole, year zero was you invested 100,000 in year one, you will get, you actually you got 40,000, but if you will take its present value, it will become 36,000. In second year, it will become 29,000. In third year, 30,000 became equal to 23,000. I am taking the present value. And in the fourth year, it is 17,000. Now, if you start counting it, then it will become 36,000 plus 25 plus 29 is 65. In the second year has been recovered. In the third year, 20 plus 23,000, 88,000 has been recovered. And so in the before fourth year, 100,000 whole has been recovered. Remaining part was 12,000 after second year. You can see it from here. 36 plus 29, 65 plus 23, 88. Now, after the third year, 12,000 are remaining. But in the fourth year, you got actually 40,000, which has the year, or I think it was 30 or some 40,000, which is the present value of 17,000. So it's mean that 12 over 17 will be the part which 3 plus will be the fraction. So here you can see in the year 3, the remaining was 12,000, fraction was 12 by 17, that is 0.71. So now the discounted payback is 3.71. Don't worry about it. I will solve these questions on the Excel sheet and you will understand all the concept yourself. So there is another method, that is net present value.